Hi guys, welcome back to the channel. My name is Dave, and if I could go back in time and talk to my younger self, these are some of the ETFs that I tell myself to buy every single week or every single month. Continue to buy and you will grow wealthy. Right? I play out just like one of those time travel movies. I go back in time, grab myself by the shoulders and give myself a good shake and say, stop having so much sex. Start investing. Well, probably just the second part. Start investing. Buy these ETFs. These are some great ones to get started with. There's plenty more, but this is a good core, young Dave. Now put on some pants and let's go get started. Want to find out what they are? Please stick around. Whoop. So before we jump into these examples, there are just a few rules that I would make sure young Dave follows. First, stay invested. Simple, but so important. Time in the market is key, and I'm sure you've heard that elsewhere. And second, to build upon point number one, the stock market eventually goes up and to the right. At least it does based on over 100 years of data, and I believe this trend will continue. So if you talk to an older investor such as myself, they can probably show you something like this where they invested 20, 25 years ago in a stock or an ETF and they have a wonderful return. In this case, it's Microsoft. Put some money in and it grew. It grew like a weed. It was just time in the market and a good stock or a good ETF. Third, corrections, bear markets, and even recessions. All these things are good for young Dave and any other young investor out there. So with so much time, buying at a lower price for a few years sounds pretty darn nice, right? Many of these ETFs on this list that I'm going to show you they're tech heavy. And if you look at QQQ, just going back to 2022, yuck, terrible, right? Down 33%. This would have been a painful year for many, but for a young investor, this is an ideal time to be buying something like QQQ. And in reality, it was a great year for anyone that would have held on until now, right? It rebounded so quickly. That's not always the case, but that certainly was the case following 2022. Fourth, if we are going to be in ETFs for 30 years, a long, long period of time, we want low fees. It will add up if you were buying those ETFs with that 1% fee tacked on to the product. I get asked about lots of products with very high fees, and that's usually my first thing that I check on about. I want a low fee. So it is simply not necessary to pay those high fees, so avoid those ETFs. And finally, while many people will be stashing away money primarily in a tax-deferred account, for those that can save some extra and put in a taxable brokerage account, which I didn't, it really did help. It is important to stay tax efficient. So income should be a low priority. Tax efficiency should be stressed. So all these products that I have on my list pay little in the way of dividends and distributions. There's just no reason to pay extra tax now. So defer it as long as you can. So with that covered, it is time to check out these 7 examples, plenty more, and go back in time and scare the crap out of young Dave.
Who are you?
So the first ETF I have to recommend to young Dave is VGT, the Vanguard Information Technology Index Fund. And I have several Vanguard funds in here. I'm not a Vanguard rep. I do like their products. They tend to have very reasonable expense ratios and they perform well. There are certainly alternatives to VGT if you find one. Have at it if you prefer that. But in this case, VGT is one that I've been buying for a few years now. It's performed very well, and we're going to take a look at that right now. So the expense ratio, as I mentioned, is just a little bit higher than some of the other Vanguard ETFs, but still reasonable. 0.1%. So what does that mean? That means for every $10,000 you invest, they're going to take out 10 bucks. Okay, so understand 0.1 equals $10 per $10,000 invested. Checks a lot of the other boxes as well. The yield is low, which means I'm not receiving a lot of income if it's in a taxable account. And performance is definitely there. We can see the 1-year performance, 43.9%. Pretty darn good. I would be happy with that. How about if we go out 10 years? The last 10 years up 480%. This has been an outstanding performing ETF. If you bought this 10 years ago, you're extremely happy. As far as what's in this fund, you're going to find things that you're very familiar with. In this case, the top holdings are Microsoft, Apple, NVIDIA, Broadcom, Adobe, Salesforce, AMD, Accenture, Cisco, and Oracle. And that makes up about 60% of the fund. So this has a total of 315 different stocks in it. And you can see it's definitely tech heavy. So today wasn't a great day for Microsoft and Apple, but you can still see that it's really been kicking butt over the years. That's my first one that I'd be saying, Dave, come on, get yourself some VGT. The next ETF for young Dave is VUG or VUG, which is the Vanguard Growth Index Fund. And it's very similar to VGT, which we just talked about, but also another great performer. So do you go all VGT? Do you go all VUG? Do you mix it together a little bit? Well, there are some perks to both, right? So for example, the expense ratio on this one is very low, 0.04%, much lower than that 0.1%. But they've both been great performers, but VGT has outperformed VUG, as you will see. This last year, it's pretty close, about 42%. But if we go out to that 10-year period, we're going to see 261%. Not a flop. It's done very well. I'll take 261% over 10 years as well. Again, low expense ratio, low yield, checking lots of the boxes that we talked about as a long-term investor. If you are putting this in a taxable account, it's looking very nice. If we look at the holdings, it's going to be very similar to what we just saw with VGT, but at a different percentage of holdings over here. So this one has only 211 holdings, so less holdings. And the top 10 make up a smaller percentage. So I would say it's more balanced, right? We don't see quite the concentration in Apple and Microsoft at the top. 13 and 12 versus what was it, 22% or so in each of these for VGT. So again, Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet, both classes, Eli Lilly, Tesla, and Visa round out the top 10. So a little bit different makeup. So you could combine both of them, put them together, young Dave, and rock and roll. The third one on my list is MGK. This comes to us from Vanguard. That makes it 3 out of 3 for Vanguard. This is their Mega Cap Growth Index Fund ETF, and another great performer. And let's just talk now. You're going to see lots of fund overlap, and if you like to study fund overlap, do that. If you want to build out a portfolio, I've got some portfolio builds. I'll link something up above. These are just some different products that you should consider, I think, and you can put together, and you can see what you like and what fits with your investment style. All of these could be standalone ETFs in a portfolio combined with a couple other things to make out a portfolio. I'm suggesting these are good options when you're young for a lot of growth over a lot of years. So MGK is number 3 for me. Expense ratio, 0.07%. Again, quite reasonable. Yield, about 0.5%. Again, checking the box. It's not paying me a whole lot, which I'm perfectly fine with. It's a pretty decent sized fund at $17 billion in assets under management. And again, you can see the 1-year performance, pretty darn good, 46%. We go out 10 years, what do we see? 288%. So I can tolerate both those numbers. Sounds pretty good to me. And again, if we go over here and we check out the holdings, we're going to see some similar products in here, very similar to the last one. A little bit higher concentration in Microsoft and Apple, Amazon, Nvidia, Meta, Alphabet, both classes, Eli Lilly, Tesla, and Visa. So very similar to VUG as far as the top 10. But the number of holdings drops all the way down to 85. So more concentrated in these large cap, mega cap stocks. Next up on my list is SCHG. This is the Schwab US Large Cap Growth ETF. Finally moving on from Vanguard over to Schwab. And this has been around. It's performing really well. And we're going to see it's similar to makeup to the last one we looked at, MGK. But in this case, it's a Schwab version, a little bit lower of expense ratio at 0.04%. Again, a very low yield, a $25 billion ETF in this case, assets under management. And we see a 46% 1-year return and a 10-year return, and that almost 300%, 295%. Outstanding 10-year performance for SCHG. If we jump over and we take a look at the top 10 holdings, again, very similar makeup. In this case, we have 251 stocks in this ETF. We've got Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet, both classes, Eli Lilly, Broadcom, and Tesla. So a couple of these are switched around, but it's very similar. So you don't need all of these. I probably would go with pick your 2 favorite flavors and get after it. Now, if you decide to buy all 4, everything that we've talked about thus far, if you put all 4 of these together, it's going to be a little bit more of a messy soup, but they've all performed very well. But you can see the discrepancy between like VGT's total 10-year return being more focused on technology, so I'd probably go for that. I believe in past history, especially when it's 10 years looking back and thinking forward. That would probably be the one that I would probably put the largest emphasis on, even though it has a slightly larger expense ratio. But still, this is a great fund. You might consider SCHG as well. Next up is one of the world's most popular ETFs, and that's IVV, the iShares Core S&P 500 ETF. I, of course, could have shown you VOO from Vanguard, but I figured you've had enough of Vanguard for a while. So with IVV, but IVV, SPY, VOO, all the same thing. You can even put VTI in there for all I care. Small cap, mid cap, don't really matter. This is what drives the market in most instances. So I just buy the S&P 500. It's about as simple as you can get. And the great thing about these funds is that expense ratio is about as low as you're ever going to find. Expense ratio 0.03%, $3 for every $10,000 you invest. So even when you make this into $1 million, young Dave, you're still not going to be spending that much every year to manage that fund coming out of your account. It's going to be pretty nice. Now, this one has a little bit of a higher yield. We're talking about all S&P 500, 500 stocks in this case. And that's going to raise that yield up because you're going to have a lot of those dividend-driven stocks that are in there too, some of those old guys. And that's yielding out 1.35%. So, yeah, that's the S&P 500. And again, if you want to keep investing simple, you just dollar cost average into something like IVV and you're going to have success. But with only 26% over last year, it's underperforming a lot of those tech stocks. So those tech heavy ETFs have, over the long term, I would expect a better return. But always want to include the S&P 500 if you want to make that as a component. Not a bad one to get invested in, because if there are times or periods when this will outperform those tech stocks, those tech ETFs, I should say. So 10-year return, 176%. Still pretty darn outstanding 10-year run that we've been on, even with that one big dip back here in 2022 because of those tech stocks. But again, buying opportunities for young people. When we look at the holdings for the S&P 500, guess what? We're going to see the same thing we saw in those other ones because those are the things that drive the market. Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet, Berkshire, sneaks in there, Alphabet, Eli Lilly, and Broadcom. And again, now this only makes up 32%. You've got all 500 holdings in there for the S&P 500. So an outstanding option for people that want to keep it simple. The S&P 500, just buy it. Continue to buy it. Next up is VXUS. We're back to Vanguard. In this case, it's the Total International Stock Index ETF. And I'm sorry to do this to you, young Dave, but you need some international exposure in my opinion. You don't need any bonds, young Dave, but you do need some international exposure, in my opinion. You never know. We like to think we're the center of the universe here in the United States, but we're not. There's other things that go on. Just not for the last 10 years, as we're going to see. So if we look at this, we see expense ratios relatively low, 0.08%. We do get 3.2% almost off of this yield, so that's not too terrible. In the last year, it's performed okay, returning 8%. That's not terrible, right? I take 8% a year in a lot of my investments. But as we zoom out, we're going to see over the last 10 years, nothing's really happened in the international market as a whole. So overall this time, 16%. Very poor performance over the last 10 years. At least it's not negative. It is positive. So we will stay positive as well. Now, if we look at the holdings, there are going to be some things you probably never even heard of. Some that you have. TSM leading the charge there at 1.6% of this fund. But it has over 8,000 different holdings. So it's very, very broad, right? So we're really talking about the global economy outside the United States. VXUS. Get it? So as a component in your portfolio, I think it's important, young Dave, to have a little bit of exposure to the international market. And that's why I included it in this video. And my final ETF for young Dave is FBTC. Of course, you can go back and buy it that long ago because it's brand new, but we could have him go back and buy a bunch of Bitcoin when it was like $1. That would be a great day, wouldn't it? But FBTC is the Fidelity Wise Origin Bitcoin Fund ETF. It's one of these brand new ETFs that come out and they buy Bitcoin. In this case, it's actually kept at Fidelity versus being kept at Coinbase like a lot of them. So what are your feelings on cryptocurrency, Bitcoin, Ethereum, and things like that? My particular feeling is that it's, for me, is that as an aging dinosaur, it's almost like an insurance policy. It's a very small portion of my portfolio. It's not going to hurt me if it doesn't perform well. If it does perform really well, it's kind of an insurance policy, right? So that's one of the reasons that I own some Bitcoin and some Ethereum and some FBTC in this case. I bought some day one and day two. I've been averaging in over since it came out, like an old person would with a Bitcoin with an ETF wrapper. So it's playing out pretty well so far, up over 50%. Yay! We'll see where it goes from there. Not a huge component, but something that I feel like is necessary. And as people like myself fade to black, and new people are coming up like my son that are into this kind of thing and talk about it a lot, I imagine that's going to continue to drive the price and it's going to become more and more valuable. I think it's going to continue the pace that it's at least for a while. So we'll see where it goes. So what are your feelings on FBTC? Let me know. But for young Dave, I'm telling him to buy some. Have some in your portfolio just in case. So that's my last one for today. So that is my initial list of 7 ETFs for young Dave to start dollar cost averaging into over the next 20 or 30 years so that he can make bank baby and retire a wealthy man. At least that's the plan, young Dave. Now, if you have any questions on any of this, please ask down below. If you've got some comments on ones that you like, don't like, or you want to see next time, please let me know down below as well. And like and subscribe if you like this type of content. I am a Seeking Alpha affiliate as well. All that information came from Seeking Alpha. Affiliate links are down below if you want to join, if it makes sense for you. And next video is probably going to be on 50-year-old ETFs because that's where I am, and that's what I'm looking at. So that's what I usually think about. I don't have to go back in time or anything. It's right here, right now. So like and subscribe. We'll see you next time. Take care. Whoop.